This is Trade Alive with IUX, where markets come alive and trading gets real. Let's go live.
This podcast is brought to you by IUX Trading Platform, elevating your trading experience.
Hello, listeners, and welcome back to the IUX podcast, a part of Trade Alive, brought to you by IUX Education and IUX Trading Platform. We help you explore the lives, lessons, and legacies of the world's greatest traders. Take a moment to visualize your trading screen. If you are like the vast majority of modern market participants, your charts are likely a kaleidoscope of colors. You have a moving average weaving its way through the price like a snake. Below the main chart, you have the Relative Strength Index, or RSI, oscillating back and forth between overbought and oversold lines. Perhaps you have the MACD histogram flashing green and red, or Bollinger Bands squeezing and expanding around the candlesticks. It is a beautiful, highly technical, and incredibly complex visual display. It makes you feel like an analyst. It makes you feel like you are at the helm of a spaceship, deciphering advanced mathematics to predict the future. But I want to challenge you today with a profound and perhaps uncomfortable truth. What if all of that complexity is actually blinding you to what is really happening? What if the dashboard you have built is not a window into the market, but a wall blocking your view? Today, we are going to strip all of that away. We are going to turn off the noise, delete the overlays, and return to the absolute foundation of market speculation. We are diving deep into the art and science of raw price movement. Our topic today is mastering price action, focusing specifically on price action trading strategies for beginners without indicators. By the end of this session, your perspective on how the financial markets operate will be fundamentally altered. You will no longer look at a chart and see a confusing mess of wicks and bodies. You will read it like a gripping novel where every candlestick is a sentence, every consolidation is a paragraph, and every trend is a chapter in the ongoing story of human psychology, supply, and demand. Let us begin by addressing the elephant in the room: the modern trading platform and the illusion it creates. Over the last 2 decades, retail trading has experienced a technological renaissance. We now have access to tools, algorithms, and charting software that only elite institutional desks possessed 30 years ago. As a result, we have been conditioned to believe that many traders believe market analysis can be simplified through increasingly complex indicators, the one mathematical combination that will finally tell us exactly when to buy and when to sell with absolute certainty. However, as experienced, veteran traders will almost always point out every single one of these traditional indicators shares a massive, unavoidable, and underlying limitation. They are all mere derivatives of price. What does that actually mean? Let us break it down conceptually. Think about what a moving average is. Whether it is a simple moving average, an exponential moving average, or a weighted moving average, the formula is taking the closing prices of the last X number of candles, adding them up, and dividing them by that number. It is taking data that has already happened, processing it through a mathematical equation, and plotting a point on your screen. Because indicators rely entirely on historical data to calculate their values, they are inherently and fundamentally lagging. They do not tell you what the market is doing right now, and they certainly do not tell you what the market is going to do tomorrow. They only tell you what the market did 5 minutes ago, an hour ago, or a day ago. Relying primarily on indicators to make trading decisions is exactly like driving a high-speed sports car down a winding mountain road while exclusively looking in your rearview mirror. You might have a perfectly clear picture of where you just were, but some traders argue that relying solely on indicators may not provide a complete picture of current market conditions right in front of your windshield. Some traders argue that indicator-based signals may react after price movements have already begun, although different analytical approaches may suit different trading styles. The institutional money that caused that move is already in the market, and you are entering late, buying the position that they are preparing to sell. For those seeking a foundational understanding of market dynamics, many seasoned market analysts suggest that some traders prefer focusing primarily on price movements rather than relying heavily on indicators. This practice is what we call price action trading. Some market historians consider price action trading to be the modern-day equivalent of tape reading. To understand this, we have to look back at the history of speculation. A century ago, figures like Jesse Livermore, Richard Wyckoff, and Bernard Baruch did not have computer screens. They did not have candlestick charts, and they certainly did not have the MACD. All they had was the ticker tape. The ticker tape was a literal ribbon of paper dispensed by a machine, clicking away all day long. It printed only 3 pieces of information: the ticker symbol of the stock, the volume of the transaction, and the price at which the transaction occurred. That was it. Raw price and volume. Yet, these pioneers made millions, and sometimes lost millions, by simply reading the flow of those numbers. They watched how the price behaved at certain key levels. They observed the speed and momentum of the prints. They were reading the collective mind of the market in real time. When you study historical and real-time price movement without the reliance on traditional indicators, you are doing exactly what those legends did. You are studying the literal footprint of where the money is flowing. Every single tick on your chart represents a real transaction between a human being or a computer programmed by a human being. Someone had to agree to buy, and someone had to agree to sell at that specific price. When millions of these transactions aggregate, they create a direct reflection of supply, demand, and market psychology. Fear, greed, panic, exhaustion, and exuberance, all of these raw human emotions are permanently recorded in the price action. According to many experienced traders, some traders report that studying price movement directly may provide an alternative perspective on market structure. You might stop asking, "What is my indicator doing?" and start asking, "What are the buyers and sellers doing?" You shift your focus from lagging mathematical averages to the actual real-time behavior and decisions of market participants. Market participants may interpret indicator signals differently, and market turning points are often influenced by multiple factors. A market typically turns because at a specific price point, the supply of an asset finally overcame the demand for it. This perspective represents one way some traders choose to analyze. It removes the mystery from the market. It takes you out of the passenger seat and puts you firmly behind the wheel. When you understand price action, some traders choose to focus primarily on price movement, while others incorporate news, indicators, and additional analytical tools into their decision-making process. You only need the raw, unadulterated truth of price. Let us move forward and dissect exactly how to read this language. Now that we have established why some traders view price action as a primary source of market information, we must learn how to actually interpret it. When developing price action trading strategies for beginners without indicators, you are essentially learning a new language. You are learning to analyze the historical behavior of the market. And just like analyzing any complex system, the market has a setting, a structure, and moving parts. To become fluent in this language, your core focus must remain on 3 foundational elements. Supporters of price action trading often believe these concepts may help interpret market behavior alongside other analytical approaches. These elements are market structure, supply and demand zones, often referred to as support and resistance, and candlestick anatomy. Let us explore each of these in profound detail, starting with the absolute bedrock of market analysis: market structure.
If you take nothing else away from our time together today, let it be this. Some traders use market structure as one factor when forming a market view. It is the compass that keeps you from getting lost in the woods. Many beginners look at a chart and just see a jagged mountain range of prices moving randomly up and down. But there is a very specific architecture to this movement. Markets do not move in straight lines. They move in waves. They push forward, they pull back, they gather energy, and they push forward again.
When a market is in an uptrend, it follows a very specific structural pattern. It makes higher highs and higher lows. Let us visualize this. The price pushes up to a peak. That is your high. Then, profit taking occurs, and the price pulls back, creating a valley. That is your low. The buyers step back in, and the price pushes up again, surging past the previous peak to create a new, higher high. Then it pulls back again, but this time, the valley it creates is higher than the previous valley, a higher low. Why does this happen? What is the psychology behind a higher high and a higher low? It is simple but powerful. It signifies that demand is drastically outpacing supply. It means that buyers are so eager to acquire the asset that they are willing to pay a higher price than they were just a few hours or days ago. And when the price pulls back, buyers step in earlier and earlier, refusing to let the price drop to its previous lows because they perceive extreme value. Psychology is dominated by aggressive accumulation. Conversely, a downtrend is characterized by lower highs and lower lows. The price drops to a valley, bounces up to a peak, but fails to reach the previous peak, creating a lower high. Sellers then slam the price down further, breaking past the previous valley to create a lower low. This structural sequence tells you unequivocally that supply is overwhelming demand. Sellers are so desperate to exit their positions that they are willing to sell at increasingly lower prices, and buyers are completely unwilling to pay a premium. Understanding market structure may assist traders in analyzing market conditions, although it does not eliminate trading risk. It keeps you trading in the direction of the dominant momentum. One of the most common ways novice traders lose their capital is by constantly trying to guess market reversals. They see a market dropping aggressively and they think, it has gone down so much, it has to bounce now, so they buy. And the market crushes them, making another lower low. They are standing in front of a freight train trying to stop it with their bare hands. Some traders use market structure as part of their decision-making process, although outcomes remain uncertain.
The second foundational element is supply and demand zones, traditionally known as support and resistance. This is where we must correct a massive misconception. If you read a standard trading textbook, it will tell you to draw a single, thin horizontal line at the bottom of a chart and call it support, and a single thin line at the top and call it resistance. Some traders consider broader supply and demand zones more useful than precise support and resistance levels. Support and resistance should never be viewed as exact, thin, microscopic lines. Markets are not precise mathematical equations. They are auction houses filled with millions of participants. Therefore, these areas must be viewed as historical supply and demand zones. They are broad areas, or blocks of price, where the market has previously reversed due to a massive concentration of buying or selling interest. Imagine a large institutional player, a multi-billion-dollar hedge fund, wants to buy 50 million shares of a stock at $100. They cannot just click buy all at once. If they did, their massive order would instantly absorb all the selling liquidity, and the price would shoot up to $110 before their order was even fully filled, giving them a terrible average price. Instead, they break their order up. They buy 5 million shares at $100. The price bumps up to $102. They wait for retail traders to sell and push the price back down to $100. Then they buy another 5 million shares. This creates a floor, or a demand zone. Eventually, the price leaves that zone and trends upward. But months later, when the price finally drops back down to that $100 level, what happens? Two things. First, the institutional player might still have leftover unfilled buy orders sitting exactly in that zone. Second, the memory of the market kicks in. Millions of traders look at their charts, see that the price bounced massively at $100 in the past, and they decide to buy there as well. The sudden influx of orders halts the downward momentum and reverses the price. Identifying these structural pivot points may help traders locate potential areas for risk definition. It is often theorized that if the price enters a historical demand zone, there is a possibility that the order flow could shift from selling to buying, though it is never guaranteed. This brings us to our third and final element, the magnifying glass that lets us see the actual battle taking place within those zones: candlestick anatomy. If market structure is the macro narrative and supply-demand zones are the setting where the action happens, candlestick anatomy is the micro narrative. It is the real-time, minute-by-minute battle between buyers and sellers. Many beginners try to memorize dozens of complicated candlestick patterns. They try to remember the exact definition of a 3 black crows, a morning doji star, or a harami. You do not need to memorize these names. The names are irrelevant. What matters is understanding the behavior and the story behind the candle. Every candlestick has 4 data points: the open, the high, the low, and the close. The body of the candle represents the distance between the open and the close. But the most important part of the candlestick for a price action trader is the wick, the thin line extending above or below the body. Wicks represent rejection. They represent a change in power dynamics. Let us walk through a very specific real-world example to illustrate this. Imagine the overall market structure is in a clear uptrend. We are making higher highs and higher lows. The price begins to pull back, and it enters a strong demand zone, a support area that you have identified on your chart from previous historical bounces. You do not just blindly buy because the price touched the zone. You must wait for the market to prove that buyers are actually stepping in. So you zoom in and watch the candlesticks form within that zone. Let's say you are watching a 1-hour chart. The hour begins and aggressive sellers push the price deep down into the demand zone. For the first 45 minutes of that hour, the candle is dark red. It looks incredibly bearish. Retail traders panic. They see the big red candle and they start selling, thinking the support is going to break. But then something shifts. In the final 15 minutes of the hour, the institutional buy orders sitting in that zone are triggered. Massive demand hits the market. The buyers aggressively overwhelm the sellers. They absorb all the selling pressure and start driving the price rapidly back up. By the time the clock strikes the top of the hour and that candle officially closes, the price has been pushed all the way back up to where it opened.
What does that candle look like on your chart? It has a tiny body at the top and a massive, long wick extending down into the support zone. Often called a pin bar or a hammer, the name does not matter. The interpretation is that sellers attempted to push the price down, making a significant effort, but they were substantially outweighed by buyers. Some traders interpret this as evidence that buying interest may be emerging exactly where you anticipated it would.
Now, look at what we have done. We have combined all 3 elements. We waited for the price to reach a key structural supply-demand zone. We ensured we were trading in the direction of the established market structure trend. And finally, we waited for a specific candlestick anatomy rejection to confirm the entry. This is one example of how some traders approach market analysis. By combining these 3 elements, a trader formulates a structured analytical framework based purely on raw market mechanics. You are no longer guessing. You are not waiting for a moving average to cross. You are reading the actual footprints of institutional money and positioning yourself alongside them. As we have thoroughly explored today, some traders believe price action provides a different perspective from indicator-based analysis if used as the primary basis for decision-making. They are merely lagging mathematical interpretations of price. They are the echo of the shout, the ripple of the stone thrown into the pond. The price itself is the stone. Many price action traders regard price movements as a key source of market information and the undeniable footprint of institutional money entering and exiting the market. We learned that developing a robust strategy without indicators relies on a deep understanding of the macro narrative. You must map out the market structure. You must recognize whether the tide is coming in with higher highs and higher lows or going out with lower highs and lower lows. This single habit prevents you from fighting the dominant current of the market, which is where the vast majority of capital is lost. We discussed the critical importance of respecting historical supply and demand zones. Moving away from the amateur concept of thin support and resistance lines, we now view the market as a landscape of institutional order blocks. We understand that these zones are the battlefields where the balance of power between buyers and sellers drastically shifts due to aggregated liquidity. And finally, we zoomed into the micro-narrative by interpreting the real-time battle through candlestick anatomy. We learned to look past the superficial patterns and focus on the story of rejection, specifically through the behavior of wicks. A long wick at a key zone is the market speaking directly to you, confirming that the anticipated reaction is indeed taking place. Some traders use these concepts to help interpret market activity during different market conditions, and significantly less lag. You are no longer reacting to a mathematically delayed signal. You are responding to the live heartbeat of the market. Now, I must be completely transparent with you. Mastering naked chart reading is not something that happens overnight. Taking the training wheels off, removing the indicators you have relied on for so long, can feel incredibly intimidating at first. You might feel a sense of vertigo looking at a blank chart with nothing but black and white candles. It takes dedicated screen time. It requires you to sit in front of the live market, observing how price behaves at these zones day after day, week after week. It requires profound patience to wait for the perfect setup to align, to wait for the structure, the zone, and the candlestick rejection to all synchronize before you risk a single dollar of your capital. However, many traders consider education and market observation important components of their development. By learning to read raw price action, you are building a resilient, unshakable foundation. Developing analytical skills may support long-term learning and market understanding, and a skill that works across all timeframes and all asset classes. Whether you are day trading currency pairs on a 5-minute chart, swing trading commodities on a 4-hour chart, or building a long-term stock portfolio on a weekly chart, the mechanics of human emotion and supply and demand remain exactly the same. This methodology empowers you as a market participant. It allows you to step away from the confusing, contradictory noise of the modern trading industry. Some traders believe this approach may help structure their analytical process based purely on raw market mechanics. You transition from focusing on what an algorithm assumes the market should do to observing and exploiting what the market is actually doing in real time. Thank you so much for joining me on this deep dive into the essence of price action. If interested, viewers may explore different charting approaches and compare them with their existing analytical methods, and just spend 30 minutes tracing out market structure and drawing your supply and demand zones. You may notice different ways of interpreting market behavior when using alternative charting approaches to you. Before we sign off, I want to leave you with a question to ponder, and I would love to hear your thoughts in the comments section below. What is the one traditional trading indicator you currently rely on the most? And after listening to this breakdown of price action, how do you think you could replace its function by simply looking at the raw structure and candlesticks on a naked chart? Think critically about that. Drop your answers in the comments. Let us get a great discussion going. If this episode gave you valuable insight, you can click like, subscribe, follow, and share it with another trader who might need this reminder. In the next episode, we'll dive even deeper and explore more. Thank you for listening. See you in the next episode. Goodbye.
You've been listening to Trade Alive with IUX. Ready to put these insights into action? IUX is here to power your next winning trade.